Hello and welcome to the Q4 Outlook on the economy and investment markets. If we haven't met, my name is Brian C., but I'm glad that you are joining us. There's a lot of questions on the minds of investors, usually after big market gains like we've seen over the last couple of months. Everyone's really happy and thinks things are going great. But I hear a lot of concerns from folks on a regular basis this time around. And I think that's warranted because we're living in a world with two different economies that are running simultaneously. One's in a recession. The other is partying like it's 1999. And so how we invest wisely based on what's really happening out there in the real world is going to be really important as we close out the rest of 2025 and turn the page into 2026. So in this outlook, we're going to talk about the gains that we've seen so far this year, whether or not we're in a market bubble. I'm also going to help you resolve the difference between your feelings about the economy and what you see happening in your portfolio, because what you feel is definitely probably not what you're seeing in your investments. And as always, I'll share my views on the stock market, interest rates, the Fed, inflation, real estate, and some other topics like gold, which is up 40% now, by the way, for the year. So as always in these Outlook episodes, there's lots of charts and visuals. So if you're listening in the podcast feed, that's great. Consider switch it over, watch it on YouTube. It'll be easier for you to follow along. All right, so let's dive into the economy and markets as we close out 2025. Let's start with what's happened so far this year. On the chart, you can see that gold remains the top asset class for the year, up more than 45%. You probably know that your stock portfolio is up as well. Big tech names from the US get all the media attention. However, international stocks have outperformed the US across the board so far this year. They're up in the middle 20% range, depending on the country that you look at. The S&P 500, no slouch, up 14%. But even stodgy old bonds are up more than 6% for the year. So this is why diversification is so important and why it's key to go beyond just owning tech stocks or even the U.S. stock market index in a long-term portfolio. U.S. returns have been good, but a broad mix of assets has seen better performance with much lower levels of concentration risk and volatility. So it's been a good year so far for investment markets, but as always on these podcasts, it's really important not to get lost in short-term thinking when you have long-term investment goals. The next chart shows long-term historical average returns for different asset classes. Returns for the last 29 years are much more likely in line with your long-term investment goals, and much more so than anything that's happening in any one year. So the S&P 500 remains the best performing long-term asset class with returns annualizing more than 10% each year. Gold, after a decade of almost nothing, has had a big run in the last few years, but that's now growing 8% a year over the long term. Bonds are up 4% each year. And despite all the headlines around inflation, inflation is up 2.5% on an annualized basis over the last couple of decades. So when we zoom in and just look at the past decade, obviously the S&P 500 is leading the way there, returning more than 15% each year on average. Gold up more than 12%. And bonds are actually the laggard over the last decade, up only 1.8%. So as we talk about our outlook for the economy, geopolitical events, politics, markets, etc., keep in mind that we've had all kinds of major events over the past few decades. And you would be a very happy investor today if you had invested at the peak of markets right before the financial crisis, right before COVID, or right before any number of bad news cycles, right before Liberation Day, right? Over the last few decades. So managing risk and diversification is really, really important, but so is making sure that your starting point is a portfolio that's going to accomplish your long-term goals and one that you're going to be able to stick with over time. So if you're concerned about the impact of a stock market bubble on your financial future, that's probably a sign you need to review your situation. Think about your investment portfolio, the other assets that you own, whether you feel comfortable regardless of the environment, good or bad, going forward. If you're concerned, then that's probably a good indication that you should seek out some professional advice. So now that we level set a little bit about the investment environment, let's shift gears and talk about where the economy sits now and where I see it headed for the rest of the year. Once we have a good feel for the economic environment, then we'll move into a discussion of specific investment assets like stocks and bonds, et cetera, and how they might perform in the fourth quarter. So I want to spend a few minutes on what I see as two different economies that exist today. So let's start by getting your feelings out, which I know is really hard for many of us to do. Let's start there, look at some data, and then we can walk through why and what we're seeing in reality doesn't match the way that we feel. The chart that just came up shows U.S. consumer sentiment. That's a survey done by the economics department at the University of Michigan. They ask regular consumers questions like, are you financially better off this year versus last year? What's your perception of inflation? Is now a good time to make big purchases, et cetera? And the results create this index. And I won't go deep into the statistics, but good is generally in the high 80s or low 90s. That's what we saw right before COVID. Anything below 70 is generally bad and considered recessionary. And we've been having, we've just been hanging out down in the 50s and 60s and getting worse. So consumers don't feel like they're better off than last year, and they aren't optimistic about the economy. Yet we just talked about the S&P 500 being up 14% for the year. GDP is positive. So let's talk about GDP for a minute. Real GDP is how we measure whether the economy is growing or contracting. So headline real GDP in the first quarter and the second quarter of the year is running at 3.8%. So the economy is in fact growing. However, tariffs have and all the trade activity have significantly kind of altered the import-export activity that gets reported in those headline GDP numbers. Businesses imported more in the first quarter to front-run tariffs than they imported far less in the second quarter after tariffs started to take effect. Imports detract from GDP, so Q1 GDP is lower than it would have otherwise been. The Q2 is higher than it would have been. So what we like to do is kind of cut through all the noise and look at something called domestic final sales, which is the combination of consumer and business activity in the U.S. kind of gets rid of all the trade back and forth that's been happening. That number was a positive 2.9%. So no matter how you look at it, the economy is growing even after adjusting for inflation. So the economy is growing, the market's up, while bad sentiment. The issue is that the growth has been very concentrated. 100% of the increase in GDP has come from the AI boom, either directly from tech areas, those, the NVIDIAs of the world, or companies that are indirectly linked that are building out data centers, doing construction, utilities, things like that, right? All of that activity accounts for about 8% of the total economy. So 8% of the businesses and 8% of the workers are seeing these extraordinarily high levels of growth. And the remaining 92% of the economy is flat, no growth. We also see concentration in household spending. That's what drives the headline retail sales numbers that you report out. We keep seeing those come out really positive. The top 10% of households account for just over 49% of consumer spending. Those households have assets that have been increasing as stocks and other assets have been rising. So they have no trouble spending because they feel wealthier. In August, the top 10% of households grew spending at 3.3%, according to the Bank of America Research Institute. Inflation is running about 2.9%. So the top 10% grew their spending in real terms. They spent more than they spent last year, not just on higher priced goods, but they actually bought more stuff. However, even the next decile, so those earners right below the top 10%, between the 80th and 90th percentile, they grew their spending only 2.8% in August. Inflation's running 2.9%, so they weren't keeping up with inflation. So they bought exactly the same amount of stuff they bought last year. They just paid more for it. So most households aren't keeping up with inflation anymore. They're simply paying higher prices for the same goods and services. So like economic growth, spending growth is very concentrated at the top end of the economy in a small number of households. But if you're wondering what that top decile is, it's households that are making about $250,000 or more every year. Let's talk about the labor market. Same concentration issue. First, we can talk about data quality for a minute. I'm going to get a little soapbox here since we have all awakened to the fact that government data is revised. So a couple of points on this. First, government revisions, data revisions are not a new thing. This has been happening since the beginning of government surveys. As more data comes in, the BLS revises their numbers. In fact, we actually learn a lot from revisions. Historically, large revisions have meant that the economy is at an inflection point. Large positive revisions mean that the labor market's really improving. Large negative revisions mean that the labor market is really getting worse. So economists and market watchers like us, they predict the revisions of what those things are going to look like. And we take all of that into account. When we think about the economic, situation, we're not just sort of fooled by the headline numbers. So, all of the discussion about, oh man, well, what would have happened if we had known that the revisions were going to, knock the numbers down? Everyone expected that to happen. And that wasn't new information. Second, private organizations have tried to recreate the BLS surveys, unemployment and otherwise, right? This government's not very good at stuff. So, hey, can we do a better job? The problem is those versions are less accurate than the government numbers. They have higher error rates. They're less useful for decision making. Why is that? It's because other organizations can't legally compel businesses to respond, and the government can do that. So the government may have issues with delayed responses. Ultimately, though, everyone responds to the government. If you don't, you get these nasty grants to say, hey, you have to respond, and we're going to take enforcement action against you. So now, could the BLS use other data outside of employer and household surveys to inform their labor market opinion? They could. maybe, just maybe, a statistician at the BLS might have thought that lower initial response rates were a problem, and they might have put together a plan trying to modernize the surveys. But they might have asked Congress for more money to do that. Did they get that money? No, right? Congress cuts the budget almost every year at the BLS. It takes investment to build new surveys, to link data from other departments, et cetera. So, maybe over the long term, new methods might be more efficient, but just like any other business, you got to put the capital in up front to build those new systems and new processes. So the last point I'll make on government data is that it seems like everybody says, oh, well, why can't we just use tax data or payroll data to calculate unemployment? Every data set has its own issues. So survey data has lower response rates. Tax data doesn't include business owners and 1099 employees that don't pay payroll taxes on a biweekly basis, right? So if you just look at that to try to find your employment numbers, there's a lot of people that aren't going to be included in that tax system because they pay taxes quarterly. So there is no perfect data set. They all have sort of puts and takes. What we have currently is useful for us to understand what's happening in the economy. So I'll get on my soapbox now. Suffice it to say, I think you could trust the government data still. And we'll talk about we'll kind of turn to talking about what it actually means for what's happening in the labor market. So the short story in the labor market is that it's getting weaker. In addition to non-farm payrolls, you can see on the slide here, they're averaging about 29,000 over the past 3 months. So, we should be creating fewer jobs than we were a couple of years ago, but I think break-even job creation in the U.S. is still more likely 70 to 100,000 a month. When we look at the 3-month additions to the labor force, that's 89,000 jobs. So that means there's 89,000 people that are out there looking for jobs. We need to be creating 89,000 jobs, for them to find them, right? So 29,000 jobs is not going to cut it. You can see in the chart on the right, we've kind of dropped below my big black line that is the are we creating enough jobs chart, right? If we can stay on a line for a month or two, right? The data is volatile, it moves around a little bit. But if we stay this low for any length of time, the unemployment rate is going to start to rise, and that's going to turn into a recession. Outside of the non-farm payroll data, you can see that the number of job openings has also continued to decline over time, and the number of unemployed workers has now finally exceeded the number of job openings for the first time since we reopened the economy after COVID. It's normal, right? It's not abnormal for the number of unemployed workers to exceed the job openings, but that's certainly something that hasn't been the case the last couple of years. So again, the labor market getting weaker. Also, average hours worked are down from almost, from highs down to almost recessionary levels, right? So folks that do have a job, maybe companies aren't laying them off, but they're keeping hours as low as possible, not letting people work more than 30 or 35 hours a week. Lastly, the sort of the common counterpoint here is when wages, Brian, are growing, right? They're actually growing at a pretty healthy clip year over year. But a lot of that wage growth is concentrated in those sectors that we talked about. So AI, healthcare, and technology. It's not happening broadly across the economy. So when we put that picture together, I think it's easy then to see the majority of U.S. companies in the U.S. see their business activity kind of flatlining. It's not negative, but it's kind of stalling out. The majority of workers and consumers are struggling to deal with higher inflation. But a few AI-focused companies and very high-end consumers are carrying the total sort of economic statistics higher. And in fact, I think this is kind of an important point to make. If it weren't for the AI boom, we would be in a recession right now. So the difference is that stark. Before we move on to investment markets, let's spend a minute on inflation. We talked a lot about this over the last couple of months with kind of all the tariff discussion. Core PCE, that's the personal consumption expenditure deflator. Say that a few times fast. That's mine and the Fed's preferred gauge of inflation in the real economy. Core PCE is running about 2.9% currently. That's up from a low of 2.6% earlier in the year. Tariffs are contributing about 0.4% to inflation currently. So they essentially make up all of the increase that we've seen so far in the second quarter. Without the price impact of tariffs, we would have likely we'd see the economy, with inflation numbers that are certainly in the low twos by now and probably at the 2% target by the end of the year. Instead, the market's now expecting inflation to be between 3 and 3.2% around the end of the year as more tariffs come online. It is true, the U.S. companies have been eating the cost of tariffs so far. The pass-through has been probably, only about 10% or so. That's likely been because tariffs have been on and off kind of during negotiations. So companies have been able to sort of send shipments through when tariffs don't apply, move things around, et cetera. We have heard from numerous companies, including, even the big discount retailers, Walmart, Target, et cetera, that tariffs are going to have price increasing impact as the year progresses. So the idea that companies are just going to sort of eat it and move on even among, companies that are working for, or producing goods for those consumers that aren't doing as well, they're going to start to pass some tariffs on as we get into the fourth quarter. So my best guess is that we're going to see inflation move into that low 3% range and maybe stay there for the first half of the next year before it goes back down towards 2%. So it'll be like a slower burn of price increases versus the kind of all at once approach. That doesn't mean that tariffs aren't sort of a one-time price adjustment. They are. But if you've got different tariffs coming at different times, that can show up in the data over a longer period of time. So my view on that hasn't really changed much since the summer. I expect the tariffs to have about a 1% total impact on prices. And that's kind of, I think we're about halfway there today, and we'll probably see the rest of that come through the fall. So we have a very concentrated economy, very concentrated growth, lots of stagnation, combined with higher inflation. And that's not necessarily a good recipe. We talked about over the summer that kind of sets us up for stagflation light. That's the stagflation light. That's kind of the environment that we're in right now. So getting that backdrop on the economy, how then should we invest? We'll start with stocks, and then we'll talk about bonds, gold, real estate, some other things as we kind of close out. I start with stocks because equity exposure generally forms the bulk of portfolios, that are aimed at long-term growth, right? When we think about portfolio construction, the major question is really how much stock exposure should we have? Stocks, both public and private, provide the bulk of that portfolio growth over the long term. We talked about those long-term returns earlier, right? There's no substitute for equity exposure. After that important question's answered, then you fill in the rest with those diversifying assets. So when you turn on the news at night, the story of the stock market has been all AI, U.S. large cap growth. But U.S. stocks are actually lagging, like we talked about earlier, behind their international peers so far for the year. We've been actually very focused on investing outside the U.S. at the beginning of the year, rightfully so. We've talked about that a lot. Both developed markets like Europe and Japan and emerging markets, so there you can think Brazil, China, Eastern Europe. Yes, even the Chinese stock market, by the way, up 40% for the year. Imagine that, right? So what's with the big kind of performance in international markets, and will it continue going forward? The biggest single driver of foreign stock outperformance to date has been sort of an own goal for the U.S. of sorts, and that's the decline in the U.S. dollar so far this year. The bulk of that decline you can see in the chart occurred around Liberation Day in the spring, and sort of the dollar's been holding steady at lower levels since then. So regardless on your views about whether the U.S. should import more, goods or import less foreign goods, doesn't matter what your politics are. If we import less stuff, there's less demand for dollars, and then the dollar depreciates. So on top of the mechanical issues that are associated with trade, investors have also shifted assets outside the U.S. because of the political environment, really for the first time in a decade. So that has had an impact in sort of juiced returns in foreign markets. So let's talk a little bit about emerging markets specifically. First, I think it's worth noting that this category probably needs a new name. Countries like China, India, Russia, they were thought to be undergoing all these structural reforms. They were going to look more like Western economies starting in the late 1990s, and certainly by now they would have emerged right into higher per capita incomes. I think it's safe to say the economic structures in those countries are not going to change. They're not going to become Western capitalist societies. So we need to evaluate them based on where they are today, no different than any other country in the world, as opposed to sort of giving them like special emerging market treatment. So when we do that, let's talk about China first. China has largely avoided kind of a major bust from its real estate overhang, and that's really due to significant government stimulus, not that different than what we did in the financial crisis. So that stimulus, in addition to stocks that are focused on AI, that's largely the reason for the run up, that 40% run up in Chinese markets to date. China is very reliant on exports. Their reliance on the U.S. has declined over time. We talked about that some over the summer. They still have lots of unused manufacturing capacity, though, because that's what they do. They make stuff and export it to the rest of the world. So that keeps global prices low, keeps inflation down. And it also causes the economy to be a little bit weaker than the CCP would like. So I think the road forward in China, now that we've kind of gotten past the real estate overhang, I think it's going to be more difficult, in the years ahead than it has been certainly this year. India, Brazil, other economies are in better shape. They just need to sort of get their trade situations worked out with the U.S. and they can continue to go forward. Do I think that the U.S. is sort of losing its position as the main driver of economic growth? No. I think the U.S. is going to continue to be the best place to invest over the long term. But a separate question is, can international assets outperform U.S. stocks even for a decade, like they did in, kind of in the 2000 to 2010 timeframe? Can they outperform U.S. stocks? They can, especially when the U.S. has anemic growth, higher tariffs, higher stock valuations. That's what we've seen so far this year. You get some surprise fiscal stimulus from Europe, and then you get a run up in developed international markets. So That has corrected some of the valuation discount that folks talked about, for, European stocks relative to US stocks. So the stocks are not on sale anymore. So I'm not sure that we're going to see as much of the sort of dispersion of returns between the US and other countries going forward as much as we've seen so far this year. But that doesn't mean that those stocks cannot continue to perform well going forward. So let's turn to US stocks. Stocks can and do track their earnings growth over time. Companies make more money, stock prices go higher. Pretty simple, right? Investing 101. We started the year with analysts expecting 14% earnings growth across the S&P 500. So grow 14% and show a pretty good year in the stock market. I mentioned in the 2025 outlook, I thought that was pretty optimistic. Everything kind of had to go right. Obviously, with tariffs and kind of the slowdown we've seen in the economy, everything's not going right. So what's funny is earnings expectations have come down to about 9.1% for the year. You would think that would be bad news for the market, but on the contrary, the stock market is up. And that means that the multiple, the price that we're paying for those corporate earnings has increased a lot. I did an entire podcast on market bubbles at the beginning of September, so I'm not going to rehash all of that here. But despite the price run up, I still don't believe that we're in a stock market bubble. Currently, the S&P 500 trades at 22 times next year's earnings. The 10-year average closer to 18, so it's expensive. But the peak at the tech bubble was around 25 times earnings. So 22 might sound close to 25. But to get to a multiple of 25 times earnings, the market would need to rise probably above 7,300 from the just 6,800 level today. So that's another 8% from what we've seen thus far. And that assumes that companies don't grow their earnings between now and the stock market get to 7,300. So what's more likely is that earnings are going to continue to grow. And so that number will go higher and higher and higher. The other thing to think about this time around, the companies that are sporting those really high valuations are actually driving significant cash flow. It's very different than what we saw in the 1990s. Microsoft is not Webvan, okay? NVIDIA's net income has moved up from $4 billion around the end of 2022 to over $70 billion a year. That's a massive increase in real profits, real hard cash generated by the company. Alphabet, better known to many of you as Google, net income's moved up from $75 billion annually to north of $115 billion. Meta, which is Facebook, or even better, Instagram, net income has gone from $30 billion to $70 billion annually. So in my view, like bubble territory would be even higher than that 25 times earnings level this time around, because company valuations should be higher than they were in the 1990s because they're producing a lot more cash flow. So on a PE basis, the market's certainly not cheap. That would be below 18 times earnings, but it's not as expensive as it was in 2000. I'm cognizant of watching for a bubble, but I think it makes more sense to start worrying about a bubble when we get those numbers north of 25 times earnings. We can kind of revisit the whole bubble conversation. You can see in the chart, the economic concentration is in AI, and the AI and the related Mag 7 stocks are leading the way from an investment standpoint, probably to the surprise of no one in the US. That's why we start with the economy, so we can understand kind of what investment opportunities look like. So in the US, tilting towards growth stocks and away from stocks that are more sensitive to the broader economy has worked well so far this year. That's been the case for the last several years as the economy's been slowing down. So we don't necessarily have to know what the endpoint is, but if we know what the direction of the economy is, that's super helpful for making smart investment decisions. Despite the economic stagnation, AI and tech are still able to grow their businesses, right? And I think that's likely going to be the case for the foreseeable future unless valuations get super, super stretched. And again, trying to time market peaks is impossible. It's really risky to do. Instead of attempting to try to identify when sort of the music is going to stop, rebalance the gains over time in other parts of equity markets like international stocks that are trading at better multiples, or even other assets, gold, bonds. That's the best way to generate long-term portfolio returns. Sell high, buy other stuff that's low. Outside of large cap stocks, the stocks of smaller companies have also rallied a lot recently on news about rate cuts. We've seen this movie before this cycle. Small caps have been negatively correlated with interest rates over the last several years. So you can see on the chart, as interest rates go down, the Russell 2000 index moves up, then rates adjust back upward, and the stock prices go back down. When we sort of sit in this range, that's kind of in stark contrast to larger cap names that have continued to grow. The reason for that is that only about 63% of the small cap stock universe is even profitable. Every company in the S&P 500, for the most part, makes money. And that index only has 6 times, their profits are only 6 times their interest expense on a quarterly basis. So what that means is that lower interest rates really impact the profitability of those companies because that helps them pay off their debt. Far, far more important than what's happening with the debt levels in the S&P 500. So if the economy just continues to grind at sort of the sub 2% level, I think it's going to be difficult for small caps to break out of the cycle where they simply trade with interest rates. In my view, there's better ways to trade rates and capture kind of long-term growth in a portfolio. So with tepid growth, high stock valuations, my view continues to be that investors should have increasing, investors should be increasing exposure to assets that are outside the stock market, and more so as those valuations increase. In the past, that's meant giving up returns, but not really anymore. So let's talk about how we can do that without giving up some of those returns. We'll start with bonds and interest rates. So intermediate term bonds, those kind of, think 6 to 7 years in maturity, they're up more than 6% so far this year. Many of you have investment, return goals in financial plans or in endowment funds that are in that 7 to 8% range. So a well-run bond portfolio can do a lot without the risk of a market downturn. That's very different than the environment that we've been in over the last 20 years, where it's kind of stocks or nothing else. The U.S. 10-year Treasury started the year north of 4.5%. It's now sitting at just over 4.1%. So that means investors in both U.S. government bonds and corporate debt are earning both the interest coupon payments every month. So that's a good thing, earning those 4+% yields. And they're also getting total returns as the value of those bond portfolios increase. Bonds from emerging market countries, hit companies, both have led the way, kind of up more than 10% for the year. Central banks around the world have cut rates again ahead of the Fed, which drives returns. We see the dollar depreciating relative to foreign currencies. That means those interest payments in foreign currencies buy even more US dollars. So that's why you see those emerging market bonds doing so well. High yield investment grade corporate bonds have also outperformed. You can see the money market fund on the chart, the brown line, it's up 3% for the year. That's not bad for cash, but other forms of fixed income are providing 2 times or more the return, right? So holding that much cash over a long period of time is likely going to be a significant drag on your total investment portfolio performance over the long run. So you'll hear that high yield and corporate bond spreads are tight. That's a finance word. I'm just saying that, investors are not being paid much to take on that extra risk of a potential default in a corporate bond as compared to a treasury. I agree. Compared to what we've seen historically, spreads are tight. The problem is, just like overnight stock markets, those tight spreads can continue for a long while. Spreads have been tight for the last 18 months. And I think, unless we actually have a recession, unless the labor market actually turns over, which has not happened yet, then, we're going to continue to see spreads higher, right? And able to make money there, but tighter than they've been historically. So waiting for spreads to widen, it's sort of like waiting for a stock market crash. You might be waiting for a long time with no returns. So it's worth noting that, also, I think, given the U.S. fiscal situation, so high debts, high deficits, right? We don't need to relitigate all that. Lots of investors, are likely view the best large cap U.S. companies as probably equal to or better credits than the U.S. government. So it makes sense kind of that the difference in interest rates between the U.S. government and some of those really big companies like Apple would be pretty low. So I don't view the tight spreads as a super big problem unless we truly get into a recession. The Fed started cutting rates in September. Finally, I welcome them to the party of economic weakness that we've been talking about for 24 months. And the market is expecting 2 more Fed rate cuts this year. You can see from the yield curve, the shorter term rates have fallen significantly since the beginning of the year because they're expecting the Fed to cut rates, really in that kind of 2 to 10 year space. The market expects inflation and rates to moderate over the next year, but not fall that much over the long term. So that's why you can see on the yield curve, we haven't seen that much movement in the 20 and 30 year part of the Treasury curve. My view is that fair value on the 10-year Treasury is something like 4.25 to 4.75% a year based on kind of historical data. If the labor market weakens further, we have a recession, then the 10-year can fall into the 3% range. But if we kind of power through, we sit here, we just have anemic growth, I would expect the 10-year to be pretty stable from here in that low 4% range. So it's really hard to have, inflation in the 2s and 3s and a 10-year bond also in the 2s and 3s, right? You got to get some compensation for buying those bonds over inflation. So what can we do outside of the bond market? I want to talk a little bit about gold. Gold has provided strong returns in a challenging environment. It's up more than 40% for the year. Gold has been a great asset to own in this, we've been calling it sort of light stagflation, right? Stagflation light environment. If the economy slows, gold does well. If the economy speeds up and inflation goes back up, gold will also do well. So it's the perfect asset to own to hedge both of those risks, both of which are very possible scenarios from where we sit today. So we've been very positive on gold the last couple of years in these outlooks and really since COVID. And a lot of that, thus far has been based on increased buying activity from central banks, the gold market. They've sort of sold or run off their U.S. treasuries and bought gold instead. There's some evidence that central bank buying has slowed down a little bit over the summer. Central banks are on track to buy about 1,000 tons of gold in 2025. That's down about 8% from last year. So investor flows into gold have picked up as inflation rose, in the third quarter. Concerns about the labor market came back, all those things that we've talked about so far. So that's more than replaced that central bank buying so far. But those investor flows can be finicky, right? When the coast clears, the risks subside, investors will move assets back out of gold into bonds that provide yield and into stocks. So I'd be thoughtful about continuing to add to gold exposure as it nears that kind of 4,000 level. And we'll watch this fall to see if central banks kind of resume their purchases. If they continue to resume those purchases, we see more dollar weakness, those kinds of things as everybody gets back from summer vacation, or if the gold trade this time has kind of run its course. What we see with gold typically is these big run-ups and then lots and lots of sort of stagnation for a period of time. So we'll see what happens there. All right, so we've covered a lot of ground. I think we'll call it a podcast here. We've kind of gone round trip this year. Like I mentioned, we started the year looking for stagflation, then a recession, back to stagflation, and then now with today's weak GDP job numbers, maybe we're back towards the recession a little bit. I would just kind of point out economic growth is still really positive, right? So in total, we're not in a recession, even though a lot of the economy sort of feels that. But the economy is definitely slowing down, and I think that's going to remain the case for the rest of the year. So things are not all hunky-dory out there, but this is not a major recessionary environment that we're going into. Again, I think core inflation likely goes back into the 3% range by the end of the year as we get more price pass-through from tariffs, even though there's lots of other parts of inflation, the housing market, things like that, they're pulling it lower. We get back into the mid threes, and then it should definitely roll over next year and move lower. So in markets like these, and just kind of in summation, right, this is where diversification really matters. And I know every investment person might do, you need to diversify. But it's not just sort of in a theoretical sense, right? It's always true that you should diversify to manage risk, right? But in an environment where you can generate similar returns across a lot of different asset classes, right? You're far better off owning lots of different kinds of assets than just depending on one asset class like stocks to drive all that portfolio growth. We can generate strong returns from stocks, bonds, gold, real estate, infrastructure. Lots of assets can help drive those returns in this environment. And so owning some of those assets means that something that you own is probably going to outperform no matter which way the economy breaks. So diversification is really, really important in this market, perhaps more important than it has been in recent years. So I hope this perspective on markets has been helpful as you think about the rest of 2025. If you have questions about your investments or you want to talk further, I'm always happy to connect. There's a link below. You can find that either below the YouTube video or in the show notes. You can schedule some time to chat. And I look forward to talking to you all very soon.